A very good evening, everyone, to this virtual webinar organized by Committee on Management Accounting of ICAI and hosted by Vasai branch of WIRC of ICAI on the topic Management Accounting Insights, International Finance from the Perspective of Top Management. I welcome all the participants and all the esteemed speakers and guests over here to this webinar. For official welcome, I would like to invite the chairman of the Vasai branch of WIRC of ICAI, CA Abhishek Tiwari ji, for welcoming the speaker and welcoming all the participants present here. Over to you, Abhishek sir, and welcome, sir.
Thank you, Shiv Goyalji. First of all, good evening, everyone. I trust you and your family is safe and healthy. We welcome all of you on virtual meeting on management accounting side, international finance top management perspective. This webinar was organized by Management Accounting of ICAI and by our Vasai branch of WSO. We welcome today very well-known national speaker, Mr. Satya Prakash Tiwari ji. Sir, welcome. He is also expert in this topic. Now we welcome Vasai branch Secretary CA Lokesh Tiwari ji. He is a very active and dynamic personality. And we also welcome moderator CA Shiv Goyal ji. First of all, I brief our Vasai branch. Vasai branch is situated in Mumbai suburban Mira Bhayandar. Our branch is largest category branch, and in our jurisdiction, more than 4,000 chartered accountants and more than 15,000 CA students. And our jurisdiction from Mira Road to Virar. And I want to brief about Committee on Management Accounting. Like just facilitate communication and sharing of knowledge between ICAI and its members, as well as other organizations dealing in management accounting, and develop best practice guidance in the area of strategic importance to management accountants in practice and business industry, and also facilitate accountants in management in focusing, benchmarking, developing in their contributor to management account process in the organization. And also this committee be of useful for professional associations and other in formulating and consolidating the work technology through the IT initiative of committee like webcast, webinar, other technology media platforms, and migrated to e-module. So with these words, I welcome all of you. I hope today's session will be very helpful all the members. Once again, welcome all of you.
Thank you so much, Abhishek sir, for warm welcome and giving a briefing on how Committee on Management Accounting of ICAI is taking such initiatives. Thank you, sir. Thank you again. Now, our eminent speaker, Satya Prakash Tiwari ji, I would like to brief about him. Satya Prakash Tiwari ji is a BE MBA Finance from JBIMS and as well as Certified Financial Engineer and Risk Manager. He started working as a research analyst with Normas Martin. He worked at Bombay Stock Exchange Currency Derivatives. He is currently an independent forex advisor and risk manager. He is also a faculty at JBIMS teaching technical analysis and international finance. Sir, I warmly welcome you and invite you to enlighten on this particular topic, Management Accounting Insights, International Finance, Top Management Perspective. We are eager and so excited to listen from you, your deliberations, sir. Over to you, Satya Prakash, sir.
Thank you so much. Thank you, Abhishek ji, for inviting me over. I really express my sincere gratitude to Dr. Surendra Pal ji and Dhyan ji over here. Many thanks to Lokesh ji and ICA Vasai branch for providing me with this opportunity to share my insights on the international finance, the top management perspective. It is definitely a very insightful and a very long journey for me. I have been working on this subject independently for more than around 12 years now, and had been through working with most of the top management companies looking into the hedging of dollar rupee, euro INR, and most importantly, I had been worked with very eminent chartered accountants working as CFOs in many companies. And the learnings come from them. It comes from the mutual understanding and discussion and the cycles with which the dollar rupee has gone through. So today's session, I will give you a complete insight into the not only the will take you from the basics as to how the evolution has taken place and all that you will need in order to generate and develop the ability in order to understand how to manage the international finance related issues, specifically in the foreign exchange markets, and more pertinent, all the understanding that you will require in order to manage the dollar rupee and the euro INR risk, which is the primary, these are the instruments that the importers and the exporters, they are working on the primary basis. This is the currencies in which we have the exposures. Okay, so I will just share my screen and we'll start with my presentation. So international finance, top management perspective. Forex is an international payment, and we know it as an FX. From where this foreign exchange requirement comes, it comes because of the coexistence between the nationalism of currencies and internationalism of trade. The foreign exchange requirement comes because we have international trade, the cross-border trade. So the settlement of international trade requires two elements: international money and an adjustment mechanism to correct the trade imbalance among the nations. So whenever we are there in India, we have the rupee as a currency. So if we are having trades among our states, the currency rupee works well and good. However, when we are exporting or importing, there are national currency, international currencies with which we need to deal with. And in order to have some kind of arrangement with which we understand for what kind of commodity, what kind of goods, what amount of currency, which currency needs to be traded for what amount of rupee. We need to understand the depth of the foreign exchange market. So the forex market has a daily turnover of $6.6 trillion in 2019, up from 5.1 trillion in 2016. Now, this statistic, which is coming from BIS, which does a survey every 3 years, and it keeps on adjusting with some kind of arrangements where the latest updates are there. However, the consolidated figures always comes after 3 years. So we are very much waiting for the next update, because after 2019, the events have been really very interesting, and there had been a very big shift into the trading destinations and the volume and the quantity and the skewness. And then the data comes next year, we will be very much interested to look into that in detail. However, this data gives you some kind of insights into the deep depth of this market internationally. So this market is trading daily $6.6 trillion. The total value of the forex industry was increased from 1.934 quadrillion dollars in 2016 to 2.409 in 2000. So it is a substantially deep market. The forex market is a market that is operating 24 hours a day. It means that when you start in the morning on a Monday, somewhere on the Australian side, it keeps on churning into some location or the other. The market is already operational, and it almost closes for a few hours on a Friday in US side. However, with the overlap of time and the markets opening and closing time, they are very much available throughout the 24 hours a day throughout the world. So these terminals, they keep on working. So you can understand from this, a forex dealer who is trading on the currency segment, what kind of time and effort he needs to put into. The forex market is comprised of 170 different currencies, and the United States dollars (USD) is on one side of 88% of all forex trade. You understand the importance of USD. So 7 currency pairs make up to 68% of the forex market trading volume, and you will see that which one are those. These are the primary destinations. So United Kingdom, the United States, Hong Kong, SAR, Singapore, and Japan. These are the centers that facilitate 79% of all foreign exchange trading. So there is a lot of activity that goes on to these destinations. The Indian subcontinent side, our center is somewhere in Singapore, and some part of it is also being backed up in Hong Kong. So this zone in which we operate is primarily the major volumes are happening in these destinations. And in China also recorded a significant rise in trading activity, and this data is on 13th of April 2016 that we see. So there are 7 major currency pairs that we trade. Let us see which one of these are there. What is the percentage share? So 24% is for the euro dollar, euro, and Japanese yen, British pound. So these are the 7 most frequently traded currency pairs, and it shares the OTC forex turnover on the percentage terms. And this one is a bit updated recently for 2020-21. This figure appears where there are some minor increase in euro dollar, and USD JPY is again at 13%, pound is at 11%, and Australian dollar is at around 6%. So foreign exchange market turnover instruments. So if you look at it on the spot basis, the color that you can look at the color over here that indicates the foreign exchange market turnover by instruments. So we have the spot market, we have the outright forwards market, we have the FX swaps. So if you look at it, that FX swaps are predominantly the major contributors towards the major instruments that are being traded into the markets. Then we have currency swaps, options, and other products. Foreign exchange market turnover by currency and currency pair. So this is where we can see that USD at 88.3% over here, followed by Euro, JPY, EME, Pound, Australian dollar, Canadian dollar, Swiss franc, Chinese yuan, and so on. So these images are for your insights into just to give you a feel as to how deep is this foreign exchange market and how much liquidity is there into this market, and what kind of money is being moving and churning every day in order to maintain this global balance. So this data you can have an access. Link is over here. You can take note of it, or bis.org. If you Google it, you will get the complete detail. If you are interested in order to learning it in quite detail, all the statistical data that this chart is made up of, the earlier charts are made up of, all the details are very, very readily available for your easy access. So now with that, I hope you have got a clear understanding on the depth of the market. Let us move ahead and look into the history with which this currency market has evolved. So the evolution and the timeline of the international payment system started with gold standard system in 1870, and the period it lasted was up to 1914. Then we had first floating rate regime, again coming back to gold exchange standard. Then we had the controlled float, Bretton Woods, Smithsonian Agreement. We are going to look into each one of them in a bit detail in order to understand. So whenever it comes to trade, we all agree, and most of the time, most of the Asian side, they agree that gold is the actual currency. There is no dispute about that. And gold has held itself very firmly in many forms to be having the most credible instrument that people are willing in a day-to-day operation also. So if today also if someone wants to substitute currency for gold, it is very readily accepted, and the trade can still happen if gold is involved. So gold has been always been on the acceptability, the credibility of gold has always been there into the markets, and gold forms the primary base of this world era also in which we live in as the form of currency. So in the gold standard system, central banks issued paper money and held gold or silver or both in reserves to back the paper money. The international payment system was built on the following feature. Export and import of gold was freely allowed. Currency were valued in gold at a fixed rate, which was termed as a mint par rate. So the rate was fixed. Convertibility of currency to gold mint par rate was guaranteed by the central bank. So it was a quite robust system. One needs to keep gold, and then equivalent at the mint par rate, you can print your currency, and then the trade used to happen. The currency can be exchanged in one form for one trade and the other. And at any point of time, if the gold is demanded, the rate is being known, the gold was to be made good. Now, if there is an import and export of trade commodities, and instead of currency, gold was being demanded, gold has to be shipped to that current country which is demanding, and the currency is being given to the other country. So it was very well operating since from the period of 1870 to 1914, and during the beginning of the World War I, put an end to this region. There were many reasons for that, not very explicitly, discussed here in detail. And this is the primary base of the way this foreign exchange market is evolving. That is the gold standard system. So once that system collapsed, except Switzerland, most of the countries suspended the gold convertibility for resident during 1914 and 17, and the pre-war fixed exchange rate. So some kind of adjustment already was prevailing. They dropped back to the same kind of arrangement. And the key observation that the market always keeps is the sterling pound, because that was the most important currency to be monitored at those period of time. And this fall that you can see from 4.86 is considerable for the period of time that we are talking about. So definitely, if no arrangement is existing, we have some kind of floating rate arrangement. The importer and the exporter, both of them, they are agreeing to some kind of understanding, because trade must happen. The goods must go from one point to the other because of the competitive advantage, because of many other reasons, because the need is there. There are many other reasons for which the trade must happen, and these adjustments were being agreed upon the buyer and the seller in their own way. So again, the gold exchange standard, it came into existence because gold is definitely on which we have to build. So Britain restored the gold standard in 1925, and the pound dollar rate was brought to the pre-war rate of 4.86 from 3.4 a pound. So over 30 other countries established gold parity or fixed the exchange rate of their currencies with sterling pound. Okay, so now we have an arrangement wherein gold can also be fixed, and you can fix your currencies to the sterling pound. And then in return, sterling pound zone will keep the gold reserves and have pound issue. So pound played a very important role in trade. And even for us in India during that point of time, pound was the most important currency whenever someone wants to trade internationally. So the central bank held reserve predominantly in gold convertible currencies, mostly sterling pound rather than gold. And this was had some issues again it faced when the Great Depression of the late 1920s, which aided to the collapse of this gold standard system and the arrangement that was existing. And most of the thing what was happening that people who were having sterling pound, they want to sell their sterling pound and demand gold. And most of the time it happens that that much amount of gold is not available immediately for delivery and for shipment. So the arrangement again collapses. So once any arrangement collapses, we go into some kind of free float or a controlled float region. And 1931 to 1939 was that region where we have some kind of controlled float arrangement that was happening. And then the most important event happened in 1944, and that arrangement was Bretton Woods system. So they came up with an interesting system again. So the Bretton Woods system was built on the gold convertibility of US dollar. Okay? It was officially described as a fixed rate regime with a managed flexibility and was popularly called adjustable peg. So all currencies were pegged to US dollar at a fixed rate, and the dollar was pegged to gold at $35 a troy ounce. The USA guaranteed the convertibility of dollar to gold, but only to the central banks and not to the general public. So it's not that they are handling one to one. They had this kind of arrangement where they were communicating only with the central banks, and the arrangement was well in place, and it was very accepted and made acceptable to most of the trading partners in many countries. Go ahead and peg their currency to US dollar, and then US dollar in turn kept gold reserves. So that's how the importance of the dollar came into existence. So what is being stored in the history is what we read today. So the US consciously ran trade deficit to enable other countries to build up reserves in dollars, which was gold convertible and as good as gold. So now what did US do? So if you are importing more than what you export, and definitely US consumes a lot, what will happen? So if I am importing goods into USA, what I'm doing, I'm exporting dollars into the market. So I'm ultimately importing valuable product, and I'm just printing the dollar and giving it to other countries, and the countries are buying that dollar or keeping those dollar reserves because now these dollars are gold convertible. The value is as good as gold, and now there is an ease of transfer because dollar as a currency can change hands. So this is the way in which dollar went across the globe. And as of today, when you look at it, dollar is available more outside the USA. Yeah. So it is the quantity of dollars that is in circulation in the global markets is relatively much higher than whatever is happening within the country itself. And that kind of dominance it has as of today. So during the second half of the 1960s, USA suffered Vietnam War. Now they were running the trade deficit, and because of the war, the trade deficit worsened, and so the inflation picked up. Now to contain the inflation, dollar interest rate was high, which attracted further capital into the US. So they were calling, if you increase the interest rate, you are calling dollars into the country. So it has reached to a stage where US gold reserves were insufficient to meet the gold convertibility of dollar. It was obvious if you are just going to print money and just keep on circulating, actually there are no gold reserves, then what is going to happen? So free market price of gold went above the official price of $35 a troy ounce. And when I studied this, it was somewhere at that point of time. Few records show that it was around $200 a troy ounce at that point of time. So that is a subject to be researched. We don't have proper clear records on that. And the France converted their dollar reserves into gold for political and practical reasons. So Nixon administration of the US suspended gold convertibility of dollar, ending Bretton Woods system. So here there was, the France said that what it takes, for USA to just print money and send it across to us. And 1971, the system collapsed. So this image is of latest in 2021. This is of April 2021, just to show you the kind of gold reserve we are having as of now. So USA, then Germany, IMF is having a lot of gold reserve. Then we have Italy, France, Russia is holding a lot of gold, China, Switzerland, Japan, and we are on the 10th place in terms of gold reserve that we are holding. And this is the largest foreign exchange reserve. China has the largest foreign exchange reserve. India is at around 586. This is also 2020. This is December 2020. We have already increased a bit from then because of the inflows that we have. So after the collapse of the Bretton Woods system, we had this Smithsonian's agreement. So this agreement was nothing but, the US dollar was again there, but instead of gold from $35 to $38 troy ounce, and then currency was allowed to move in a wider band of 2.5%. So the exchange rate adjustments can go 2.5% up or down. And the strain in the system, so if you look at the this graph, so you can see the exchange rate is to hit the upper circuit or the lower circuit or lower band, and that's how it was kept within that band during that period of time. So in 1972-73, there was strain was developed in the system. Britain left the system and followed with others in 1973. So it was still a very temporary arrangement, and it did not last. Since 1973, we have all the countries were allowed to do the way they like. One can have a free float. So what is a free float? The forex rate is allowed to be determined by the demand supply forces in the market. Central bank did not influence the forex rate, but focused on domestic monetary policy and inflation. The currency that followed this system became the hard currency and became an asset class alongside bonds and. So if you look at the euro dollar, so as of now, it has some kind of stimulus. The lower side is being protected, is what you can observe. But few years before, that was not the scenario. It was all on its own, and subjected to complete demand and supply of the market, and it was able to hold grounds on its own. So there was no central bank intervention or any kind of adjustment on the foreign exchange rate itself. And these currencies were very, very liquid, and that's why they were being liked across the globe in order to have their import or export being hedged to these currencies, which are not subjected to any kind of adjustments by the local administration. So we had euro dollar, we had pound, we had we had US dollar, not dollar rupee. Dollar rupee is a managed float. So the forex rate in a managed float, the forex rate is allowed to be floated but controlled by the central bank. So most of the cases, the control meant periodic, minor and discretionary devaluation. So dollar rupee is an example of a managed float. When RBI is on watch, complete watch, it has all the accounts of dollars that we are buying or selling. So we are into a partial convertibility also. Dollar is not, we are not into some part of current account convertibility is there. So one can hold a current account if he has import and export. However, for a normal public or a normal resident like us, we cannot open any form of dollar account. Yet we have a liberalized scheme wherein we, up to a certain limit, we can make payments for specific purposes. Those kind of arrangements have recently come years, but before when it started, it wasn't there. And yet we are into a kind of partial managed float, the dollar rupee. Yeah, so that is an example. Then we have gliding parity, very few examples we can get of that. Wherein you have a basket of economic parameters to which the currency is being administered. So as the inflation of the specific thing changes, some kind of weightage is being given or specific criteria have been defined, well defined and well known to the market also that this currency is going to follow this kind of arrangement. Whereas we have a fixed peg where the forex rate is pegged to a currency of a country main trading partner or the basket of currencies of trading partner. So if you are looking at the AED, that is dirham, it has been pegged to the dollar. So there is a limited movement deviation from the dollar price, AED dollar pricing. So if you are in borrowing in AED or in dollar, actually makes not much difference because the exchange rate does not fluctuate much within, and neither it is almost very close to the fixed rate arrangement. And there are other currencies which are being pegged to the major basket of currencies. So instead of only single currency, you can have a basket of currencies. Now, all these arrangements have been left to the country to decide. Yeah? So that was the arrangement, and this is the arrangement in which we are now existing. So let us focus and understand a bit detail on what's happened in the FX market in India. So the origin of the foreign exchange market in India could be traced in the year of 1978, when banks in India were permitted to undertake intraday trades in foreign exchange. It was in 1990 that the Indian foreign exchange market witnessed far-reaching changes along with the shift in the currency regime in India. A lot of work is happening on that side. The exchange rate of the rupee that was pegged earlier was floated partially in March 1992 and fully in March 1993, following the recommendation of the report of the High-Level Committee on Balance of Payment, which is chaired by Dr. C. Rangarajan. The unification of the exchange rate was instrumental in developing the market-determined exchange rate for the rupee and the important step in progress towards the current account convertibility, which was achieved in August 1994. So from 1994 onwards, we had current account convertibility. So further impetus was being given by the foreign exchange market in India was provided with the setting up of the expert group of foreign exchange markets in India, Chairman Sri O.P. Sudani, which submitted a report in June 1995, and following that there were a lot of changes that the market has seen. So the link is below. You can go through the details, complete details on what exactly had happened and the history with which the foreign exchange market has developed in India, can be referred on this link that has been shared over here. Okay. Two important institutions that were formed along with the Bretton Woods in 1944, the World Bank and IMF. We all are very well aware of these institutions and the purpose that with which these, the role that they have played into the international foreign exchange markets in order to manage funds and coordinate between the countries, try to arrange funds from the people from the surplus and some form of establishment that can happen in countries which needs some kind of help in many forms. So that is a subject that is this. I have just brought it that we need to be aware that these two institutions came up in 1944-45 and they have played a very important role in the development of this market, as well as there had been a very huge impact by the working of these institutions into the global markets. So with that, that is all on the historical parameters that we need to know before we get into the foreign exchange market and understand how the intricacies and the minor details into it. So the currency pair, the forex transaction is a currency pair, and the forex price or the exchange rate is the price of one currency in terms of the other. When we are looking into a barter, it is goods for goods. So that was the barter system. When it comes to money, it was for goods for money. Whereas in forex market, it is money for money. So you're in the foreign exchange market, you are always buying one currency and selling the other. If you are selling one currency, you are actually buying the other. So at the same point of time, the currency is changing hands from whenever the buy or the sell transactions are happening. So forex market or the currency pair is about money for money. So we have the base currency and the quoting currency. So forex price or the exchange rate is equal to the price of the base currency in quoting currency. So the amount of base currency is fixed, usually at 1 unit, and the amount of quoting currency varies as the price of base currency varies over time. In this case, where euro and USD are concerned, euro is the base currency and dollar is the quoting currency. So for example, if we have euro USD and the exchange rate is at 1.2065, so we have 1 euro is equal to 1.2065 USD. So the notation above means that 1 euro is equal to 1.2065 USD. So if you are buying, the exchange rate specifies how much of the quoting currency you have to pay to buy 1 unit of the base currency. And if you are selling, the foreign exchange code specifies how much unit of the counter currency you will receive if you sell 1 unit of the base currency. So base currency is being fixed at 1 unit and the quoting currency is being allowed in order to change or vary as per the market demand and supply condition. This is the base currency and the quoting currency. So when we come to the foreign currency market, all these currencies needs to be coded. Else, we will talk about one currency pair and we are talking about only rupee or we are talking about Chinese yuan. So we don't know how to segregate and standardize. So these currencies are definitely standardized. So International Organization of Standardization ISO has given 3-letter codes for every currency in their ISO 4217 standard. The first 2 letters are the country codes defined by ISO. And in the standard ISO 3166, the third letter is usually, but not always, the first letter of the currency name. So we have United Kingdom currencies pound is GBP, Great Britain pound. Then European Union is Euro, EUR. So they did not want to make it EU because they found that not good to pronounce that word as such. Then you have USD, so it is US and D is for the dollar. In CHF, it is CHF, and that CH comes from its Latin name, which was the official name. Then we have the Japanese yen, which comes JP, and Y for the yen. We have the Indian rupee, IN is the country code, R is for the rupee. In Chinese yuan is CNY, it is called a yuan or renminbi, it is called renminbi is like people's money. And then we have the ZAR, ZAR, where ZAR comes from the Dutch name of Africa. This is the way in which, in case of precious metal, the traditionally associated with money, so ISO principle, it starts with the code with the letter X and take the next 2 letters from the chemical symbol of the metal. So it is XAU, aurum, that is for gold, and the code XAG, argentum, for the silver. And this is the abbreviation for most of the countries. It's AED, ARS, AUD, Australian dollar. Then you have Brazilian real, Canadian dollar, Swiss franc. The codes are very well defined. Most of them is available over here for your easy reference. And these currency pairs have their nickname also. When the markets are trading, when one person is trading with the other, these are the local names, the nicknames. So just to have fun into the market, they were always been called. So Euro USD was called as fiber. Then you have cable, channel, Doni. Japanese yen was called as ninja, guppy, yuppie, EV, Aussie, and Euro CC. So a lot of communication that goes on when the dealers are communicating to each other, and that's how some kind of fun exists into the markets. So we need to know the hierarchy in the currency pair. The reason that we need to know the hierarchy of the currency pair in order to understand that if we are dealing in any kind of currency pair, which currency will be the base currency and which currency is going to be the quoting. It is well defined. So we have that question, which currency should be the base currency in a currency pair and which currency should be a quoting currency in a currency pair. So the order of precedence among the major currencies has already been well defined. It is pound, euro, Australian dollar, New Zealand dollar, and US dollar. So one has to memorize these 5 currencies: pound, euro, Australian dollar, New Zealand dollar, and US dollar. So if pound is suppose going to quote against any currency in this world, it will always be the base currency. So if pound is quoting against rupee, it will be GBP INR. If it is quoting against US dollar, it is GBP USD. So pound is the currency, is the number one currency that will always be the base currency. You will not find pound as a quoting currency. Okay? And then the next in order comes the euro. Now, all the currency except pound will quote for the euro. So quote will remain, the euro will remain as a base currency. So if it is euro and any other currency, it will be euro upon INR, euro upon Japanese yen, euro upon USD. Okay. However, if it has to quote against the pound, it will be GBP upon euro or GBP by euro. And that is how we will get GBP upon euro and AUD upon. Will we have AUD upon euro? No. We'll have euro upon AUD. So euro will be the base. Euro and Australian dollar are going to put into the market system. Euro will be the base currency and dollar AUD will be the quoting currency. And that's how it will be NZD and USD. And if you look at USD, most of the currencies across the globe are all quoting against the dollar. So the way the market is functioning is that we are all quoting against the dollar, and if that currency, any currency pair that needs to quote against pound, euro, AUD, or NSD, it is adjusted for the dollar to the pound, dollar to the euro, dollar to AUD, and dollar to NSD. And that's how we will get GBP upon euro, euro upon USD. And if Australian dollar and New Zealand dollar are there, then it will be AUD upon NZD. Then NZD upon CHF, and then USD upon CHF. That's how then the currency pair fall in place. We come to know which currency will be the base currency and which currency is going to be the quoting. The order of precedence has nothing to do with the value of the currency. It changes continuously. So it's not that GBP is a base currency and rest of all of them they are quoting again. That doesn't make it great or something like that. So that understanding it is just a hierarchy that is being defined. That may be for say, maybe it may have some kind of valuation, but we are not sure. And when it was being done, maybe pound was there, but as of today, pound is not that great. It is coming relatively to its peak. It is relatively down. I hope that this is being understood. And with that, we will know which currency will be the base currency and which currency will be the quoting currency. So the cross rate are the currency pairs that do not contain the interdealer numeric currencies, which is presently dollar. So if you're looking at the quote of GBP and euro, it is actually a division of GBP divided by USD and euro upon USD. As of today, dollar is the base currency. What does that mean? It just means that you just cannot bypass dollar under any kind of arrangement or calculation in the foreign exchange market. So if you are going to, if you are looking for euro INR, Like in this example, you look at Euro INR. If someone wants to sell rupee and buy euro, it doesn't happen just directly that you sell rupee and you just get the euro. It passes through the dollar. Actually, in the transaction on the calculation part, it happens that when you sell rupee, you first buy dollars and then you sell those US dollars and buy euro, and that's how the cycle goes on. Euro on INR will be the product of Euro USD and USD INR. And cross rates are mostly being calculated either by dividing or by multiplying the two currencies. The crossing means division in some case and multiplication in the other. The key difference between the underlying rate and the cross rate is that the price of the former is determined by demand and supply forces, and the price of the latter is defined by arbitrage arithmetic. So if one of the underlying rate price changes in price, the cross rate must automatically change regardless of the demand supply situation or for the cross rate. Now in the actual market condition, you understand that we have Euro INR also quoting into the markets independently. So we have traders which are trading Euro INR. Okay. Now Euro USD is trading on its own. Dollar rupee is trading on its own. Now the product of Euro USD and USD INR at any point of time should always be the rate that Euro INR is quoting into the market based on the demand supply condition. Suppose if by due to some reason or the other, there is a lot of demand directly on the counter of Euro INR and the Euro INR prices are shooting up. One can always have the arbitrage arrangement between the Euro USD and USD INR. They can have an arrangement in which they can make the composition, make arrangements for Euro USD and USD INR and hedge it, arbitrage it for the Euro INR position. Hope that has been made very clear. So crossing means division of some cases and multiplication in others. So the difference between the underlying rates and the cross rate is that the price of the former is determined by the demand supply and the price of the latter is determined by arbitrage tariff. So maybe that has been clear. It needs more in-depth understanding. But I think most of the participants are smart, so they will be able to pick up what exactly it means. So the cross rate are currency pairs that do not contain the interdealer. Okay, this one is already been done. Let's just highlighting over here. So the quotation style. The quotation style can be direct and indirect. So consider how the price of an apple is quoted in two ways. So we can have a quote which says one apple is equal to 10 rupees, or we can have a quote which says 100 rupees for 10 apples. So if you look in the first case, what is quoted is the price of the apple, and hence it is a price quotation, also called as a direct quote. So in the markets, we will have direct quote, which will be the price quotation. And if it in the second, if you look at it, it is a volume of the apple and hence volume quotation. So it is termed as an indirect quote. So the price quotation is termed as a direct quote and the volume quotation is direct. Because the price of the apple is conveyed not directly but indirectly. What is to be known is the price of an apple, if one wants to know. So in the other case, the price of the apple is conveyed indirectly. So we have direct quotations and indirect quotations. Now another terminology very important is of pips. It is very important for the traders because they are all behind pips. So pip is the smallest price move that an exchange rate can make. So if a trader bought the euro at 1.1520 and sold at 1.1586, then he makes 0.0066 or 66 pip on the trade. So this image that you are looking below it will make it very clear. So the last fourth digit, if you are looking, is called is 8 pips, and then this is 30 pips. So if you are looking at 3 and 8, it will become 38 pips. Then 5 is 500 pips, so this becomes 538 pips, and that's how it is 1000, and this is a 10,000 pips. So it is just a notation, because most of the time, what the trader is interested, because his volume is very high, even 10 pips on euro makes a very, very big amount of gain for the trader. So there are people who are just, trading 10 pips, 20 pips, 30 pips. That is what they are chasing. When the market is rallying or there is a breakout, they get some kind of 50, 40, 30 to 40 pips. If they have made a killing on that day, because they are the volumes that they trade, maybe 10 million euros on stake, and that brings a lot of money on the table for the trader. So cross rate arithmetic. So these are the rates. So GBP by USD. These are the rates that is being seen. That I just go to over here. These are USD JPY codes. On the screen they are flashing. Maybe I can give you some time in order to just calculate on your calculator if it is available, readily available to you, and see whether it is being multiplied or divided, and how the cross rates are being calculated. So if it is GBP USD and you want GBP INR, so you're looking at GBP USD and USD INR. So what if you do multiplication, if you GBP upon USD multiplied by USD upon INR, so you can see dollar will get cancelled and you will get the rate for GBP INR. That means if you multiply 1.2687 with 74.81, this is the value that is what you will get, the rate for the GBP INR. And similarly, you can get Euro INR, in order to calculate AUD INR. So if you're looking at these ones, that is these above ones, they are all products with dollar rupees. So if you want NZD USD into USD INR, so if you take this product, then you get NZD by INR, that is the rate that you will get. And when you come to this, USD upon JPY is 107.818, and JPY INR you want to calculate. If you're looking, then this is USD INR and USD JPY. These are the two currencies with the help of which you want to get to JPY INR. So you need to divide 74.81 divided by 107.18. Now that sometimes goes to a very low decimal. That is in the case. Most of the time, JPY INR will be quoted for 100 JPY. How many INR? That will be quoted in the market. So similarly, whenever these things are happening, you are having divisions with which you can come to the cross rates. Yeah, so I just give you a minute. Meantime, I just make the calculations. So in the foreign exchange markets, we need to have a two-way code. So in the interdealer market, the participants are, that is, those who put both buy and sell price to others. So the buy-sell price of the dealer is called the bid offer or the bid ask US market. Bid is the buy price and the offer or the ask price is the sell price. So who is buying and who is selling? Who is displaying this code? The bank is displaying the code. Okay? So when you're looking at 74.8183, definitely banks, if they are quoting this, they are going to buy at 81 and sell at 83, right? So whenever we talk in the foreign exchange markets, a bigger figure 74 is most of the time not being quoted. We are just talking about the two digits in the in the paisa term. So when we say buy 81, sell 83, that is what the bank is quoting. So when bank is going to buy at 81, what is the price at which we are going to sell as an importer or an exporter or an individual who wants to sell some $100 or want to buy? So if I want to buy from the market, I have to buy at 83, and I have to sell. If I want to sell, I have to sell at 81. Now this is only only for the top level premium customers who are having huge volume or $1 million ticket in export. Those also some kind of margins will be there, 5 paisa, 6 paisa, 10 paisa, 20 paisa margins on this scheme will be loaded, and the spread will be much higher. The interbank dealing will be happening within these ports. So the arrangement is like that we have all these banks, most of these banks that we are having in our country, they have a centralized treasury where all the time the transactions, the buying and selling of dollar, euro, and most of the other currencies that are required by the market participants are there. They have to do. So we understand that we as a country are into an arrangement where the foreign exchange market needs to be supported. So RBI is there; they are supporting the banks, and the banks are the people who are supposed to give support to the customers, right? So it's not like there is the currency is in abundance and we are into a free market where anyone can buy and sell, like in case of euro dollar. We are not in that kind of arrangement. We are in a kind of arrangement wherein the requirement is to be met. So if the exporter is there and he is going to receive some kind of dollars, suppose he is going to receive $1 million, that dollar needs to be exchanged for rupees by the intermediaries that are banks. Whereas at the same time, if someone is exporting to some services or commodity to other countries, they are going to receive dollars. On the other hand, if someone is going to buy dollars in order to make the payment for their imports, that dollar must be made arranged by the market makers that are these banks. Now these banks, they need to communicate with other banks as well as in case need be with the RBI in order to make arrangement of the dollars in their day-to-day requirement. So most of the time, one banking treasury will not communicate with the other banking treasury. So there are intermediaries called as interbank brokers that come into picture. Now, what happens? What do these interbank brokers do? They are the people who make the deal good. Like whenever there is a demand for dollar, these information from the banking treasury goes to the broker, and the broker goes ahead and finds with all the banks wherever these deals can be matched, and he makes the matches the best price with the smoothness. So we are still not on the terminal based applications, whereas most of the time you will see ICAI dealing platforms are being given to the customers, and there are other banks who give a direct terminal where the customer can do their transaction. But when it comes to interbank dealing, still we are into an arrangement where the hotlines are there and the one bank dealer is talking to the broker and the broker is those kind of arrangement. Now, when we are into these kind of arrangement, the information whether I want to buy dollars or I want to sell dollars needs to be secured. And that is the reason why we are into an arrangement which needs a two-way. So suppose we have a banking treasury that has a requirement of $1 million. It wants to buy. And if it is going to tell the dealer, okay, fine, I have a requirement of $1 million, can you quote the price? He will immediately hike up the price. Even by 2 or 3 paisa is going to make a big difference for a transaction, in that transaction. So in order to safeguard the interest and to make the price more competitive, the information is secured into these kind of deals. So when a bank is going to call the broker and he is going to ask for the price, he will say quote. The broker, the dealer, the interbank dealer does not know whether the bank wants to buy or sell. And the transaction can end up buying or selling both. Now, This dealer has to be very careful when he is going to quote because he may end up buying or selling dollars, which he has to match back to back with someone else so that he can again go back to some banking treasury and pass it on to someone else. So how is this? This is a challenge that the dealer, the interbank broker is going to face because he cannot have an open position. He is not someone who he is there only to match the prices. So the moment the broker, the dealer from one bank is going to call and quote for the price, these dealers or team is already active and is already contacting other dealers, other banking treasuries for the price. And that's how each party is all quoting both way price. They are willing to buy and sell at a specific price. And the dealer, what he does, he gets the price accordingly. He quotes to the other person, keeping his margin of 1 paisa or even a quarter paisa is there or half paisa is also there. Then that if he is able to match the price, his trade is his deal is good. The explanation, the attempt is to make you understand the requirement of the two-way code, that it is very important and required so that the market remains competitive and the market is not dealing in the one-way code. So a dealer will call, the broker will say yours or mine. So there are both ways the code can happen. Either the banking treasury can call the interbank broker and say quote. In reverse reply, the dealer can say you. That means you quote your price. I will say whether I want to buy. That way also is possible. When it comes to whether he wants to buy or sell is not being known. Suppose he has a requirement. Yeah. So that kind of market communication keeps on going, and they are all on these lines. The hotline is there. Each bank has a code. You can just press up the button and it directly goes to the dealer. So as much as possible they are all recorded live. Because after the deal has happened, only the back office gets activated and the settlement is in T+2 basis. So hope the requirement of the two-way quote is being understood. Now let us see when we are quoting into a two-way market. So the arithmetic with the one-side code is simplistic and has only illustrative value. In practice, we are all dealing with two-way codes. So the cross rate arithmetic in case of two-way codes, when we are having two-way codes, we need to understand how will you calculate which currencies to multiply, which currencies to divide, and what will be the bid side, what will be the offer side. When we are quoting for Euro USD, which is directly quoting into the market, or USD INR, which is directly quoting into the market, that is well and good. But when it comes to the cross rates that are to be quoted on the ongoing market, one needs to have this understanding. So if you look very closely, we have Euro, which is the base currency. And in this case, USD INR is the quoting currency. That's why the importance of the understanding of the base currency and quoting currency becomes very important. So in the first case, one currency in the cross rate is the base currency and the other is the quoting currency in the source rate. So what it wants to tell me that this one currency, if you want to know the price of Euro INR, where one currency is the base currency in the sourcing and the other currency is the quoting currency in the source rate. So INR is the quoting currency in the source rate, Euro is the base currency in the source rate. In this case, we have not two options, two sub scenarios are existing. So one is that the base currency of the cross rate is the base currency in the source rate. So in this case, the base currency in the source rate is the base currency in the over here. In this case, whenever you have this kind of arrangement, the rule is to same sides multiply with bid of the source rate becoming the bid of the cross rate. So you just multiply these two rates on the bid side and the offer side, and you will get directly your bid rate and the offer rate. That is how you will get your bid and the offer. In the next scenario, we will see. In this, if you are looking, now you want INR Euro. Now what is happening over here? The base currency of the cross rate is quoting currency in the source rate. So here INR is the base currency and INR is the quoting currency in the source rate. And in this kind of scenario, it is still same side multiply and then take the reciprocal of the derived rate and reverse the bid offer side for the cross rate. So if you are going to do this, you can just multiply it, take the reciprocal and shift the side. Or like if you have the earlier arrangement, you can calculate multiply for the euro INR and then you take the reciprocal. That arrangement is also possible. The next one is what if the both currency in the cross rate are quoting currency in their source rate? Then what will happen? The rule is pair the opposite sides and divide. The numerator being the source rate containing the quoting currency of the cross rate. Numerator being the source rate quoting the quoting currency of the cross rate. So just pair the opposite sides and divide accordingly. You will get, and then you shift. You will get the rate in this case of the cross rate. Now the third scenario is that both currency in the cross rate are base currency in their source rate. So you have euro and USD, both are the base currencies in their source rate, and you want to know what is euro USD. In that case, pair opposite sides and divide. The numerator when you are dividing being the source rate containing the base currency in the cross rate. So euro USD will be the rate. That will be there in the numerator. Pair opposite sides, divide, and then place the value. You will get the cross rates. So with this, the basic understanding on the cross rate and other terminologies of the foreign currency pairs has been very well understood. What is the hierarchy? How to calculate? What are the pairs? And how to calculate under all types of scenarios? The cross rate calculation has been understood. Now let us understand one more very important. What is value date and settlement date when you are dealing with the foreign markets, exchange markets? The value date is the exact date when the transaction is settled. That is the actual transfer of fund takes place. And the trade day is the day on which the transaction takes place. So normally the settlement is on T+2 basis. So we have London. There is one A and B who is there in Paris. These are two different destinations in this case, and they are dealing in USD and JPY. So A is selling JPY and A is buying dollars. B is selling dollars and B is buying JPY. So that is where we are looking at from A's perspective and B's perspective. So most transactions are primarily spot or forward. When currencies are traded, the trade has to be settled in country in which the transaction takes place. Okay, so that is very important for you to know that when the currencies are traded, they have to be settled in their own respective, the currency in which they are originated. Like in case whatever dollar rupee we are trading into the market, the dollar has to be settled in New York or in USD. It is not settled in India. Similarly, rupee that is being traded across the globe needs to be settled in India. Okay, so currencies are settled. That's how the holidays in US and in India are going to affect the settlement dates. So the Nostro account, there are two account names that have been referred: Nostro account and Vostro account. So the Nostro account is account opened offshore by a foreign bank, and a Vostro account, it is a Nostro account of one bank, is a Vostro account for the bank of origin of the currency. So there is actually only one account. It is the reference point that is changing the terminologies. With fewer examples ahead, it may become clear. So Nostro account is ours. It is a bank account held by a UK bank. That is an example. It's not necessary that it has to be held in a UK bank. With a foreign bank, usually in the currency of that country. So the Nostro account refers to an account that a bank holds in a foreign currency in another bank. And a Vostro account is a bank account held by a foreign bank with a UK bank, usually in sterling. So Vostro in Latin word that translates into your as your account. So let us look into this example. So we have State Bank of India. So all the dollar transactions that are happening in State Bank of India Treasury, they will have a Nostro account in Citibank USA where all the transactions instructions will go to Citibank to their Nostro account and all dollars will be settled in Citibank USA. So SBI opened a current account with Citibank in in USA. This account is called Nostro account for Indian. That is for SBI, it is called as a Nostro account. So SBI is going to call its account in Citibank USA as a Nostro account. So if it wants to give a detail to any of the customers, which account needs to be credited, wherever they are going to get dollars, or from where they need to, dollars are going to come to them, it will be always the Nostro account of SBI that it is holding. So in other way around, if you look at what is a Vostro account, so the Citibank opens a current account with SBI in INR in India. Now this is called as a Vostro account in India. It will be a Nostro account for Citibank. However, in India, if SBI wants to call it, it will call it as a Vostro account of Citibank, which is held in a local currency within India. So Vostro account is an account which is held by a foreign bank with a domestic bank in a domestic currency. So if Citibank maintains an account with SBI in India in INR, it will be Vostro account for SBI. Okay, and that same account Citibank is going to call it as a Nostro account. So it's actually referring to the same account with two different, people are calling that. So notice that an account which is a Nostro for one bank is Vostro for another. As in the above example, when SBI opens a Nostro account for Citibank, it is Vostro account for Citibank. Similarly, a Vostro account for SBI is actually a Nostro account for Citibank. As such, a Nostro account and a Vostro account refers to the bank account from different banks' perspective. We have Loro account. Now, if SBI has a Nostro account with Citibank in USA and PNB wants to have some kind of arrangement where PNB wants to use the SBI Nostro account is being used by PNB for its correspondence, this is referred to as a Loro account by PNB. So a Loro account means our account of their money with you. It is a current account maintained by one domestic bank, say SBI, with other domestic banks, say PNB. Here PNB does not have a current account with Citibank and uses SBI's Nostro account with Citibank for some transactions. So that settles on the account details on the Vostro and the Nostro account. So that is very important understanding on that. Now let me come to the international linkages, which is one of the very important of the time this kind of derivations are doing. So this part is very needs careful attention and is very important. So international linkages. Law of one price applied to international commodities market. And we will work on the purchasing power parity to identify law of one price, which will be with the help of purchasing power parity. Then we have law of one price applied to international money markets, international foreign exchange markets. That's covered interest parity or covered interest arbitrage. And we have the uncovered interest rate parity, UIP, and we will conclude this part with Fisher's theorem, where real rate of interest is same for all countries. So law of one price, purchasing power parity. So what we want to say is the price of any commodity when expressed in common currency is the same in all countries. That is what the purchasing power parity wants to say. So the equation is that P of the ith price of the ith commodity in US will be equal to price of the ith commodity in UK multiplied by the adjustment E, that is the exchange rate. Where I is the ith commodity, so any commodity that is homogeneous in property, and the assumption in this equation is that there is no transaction cost and there is no friction, that is duties and taxes. That is the assumption with which we want to establish some kind of relationship. So in case suppose the price of this ith commodity in US is greater than price of the ith commodity in UK, when it is been multiplied with the exchange rate, the adjustment, where these two commodities should be having the similar pricing, but there is some kind of change. In order to get the equilibrium, in order to achieve the equilibrium, we take the log, natural log from the both sides. So ln of pi US is equal to ln of pi UK into the exchange rate. And ln of m into n is ln of m plus n, that is just the expansion of the brackets. So we get ln of pi US is equal to ln of pi UK plus ln of E. Now what is, we just denote it as, when we talk about ln, it is nothing but percentage change, okay? So P hat IUS, that is a notation, that it is a change in price, is equal to change in price. P hat IUK is equal to E hat, that is there is change in exchange rate also. So percentage change in price is nothing but inflation. So we denote inflation with pi. So pi in US is equal to pi in UK plus the exchange rate. Change in exchange rate, not exchange, change in E hat. So E hat is equal to pi US minus pi UK. And with this equation, we get something that is very useful for us to always understand. That percentage change in exchange rate is nothing but inflation differential between two countries. So the first relation that we have established is between the exchange rate and inflation. And the difference is, we have inflationary pressures between the two economies. They are going to have a direct impact on the exchange rate. So we talk about something called the impossible trinity. The visualization is like, in order to understand, is that imagine that we have a ball in our hand which has 3 holes. Not in our hand. Suppose there is a ball in the hands of the RBI governor who wants to, the central bank governor. He is holding a ball in his hand which has 3 holes. The first one is interest rate, the second is inflation, and the third one is the exchange rate. Now, at any given point of time, he can tweak with either the interest rate or the exchange rate or the inflation or in combination of two. At any point of time, he cannot close all the 3 holes. If he is going to tighten all the 3 holes, the pressure is going to develop inside the ball and the economy will be subjected to this. Most of the time, we observe that the interest rate and the exchange rate is very visible. But to manage inflation, targeting inflation is one of the very difficult parts that the central bank faces. And they have their own means and methods in order to manage inflation into the market as per their requirement. The reason being that the inflation is going to affect the exchange rates. Exchange rates are connected to interest rates. But how? Is this equation we come up with? That change in inflation, the difference between the inflation of the two prices is nothing but change in the exchange rate. So this is one of the derivations which is very important to notice. Percentage change in exchange rate is nothing but inflation difference between two countries. So if you are observing that one economy is having inflationary pressures and consistently rising, immediately the currency will get affected at one point or the other. It cannot bear. And that, if you look at during Rupee at 40 and 42, that was exactly what's happening over there during that point of time. Then we come to the law of one price. What is law of one price? The law of one price, when applied to international money market and international foreign exchange market, it says Investors get same returns regardless of the currency they invest. So you go with your capital across the globe and look for investments. Whatever investments you will get will be same as that you will get in India. That is what it wants to tell us. So investors get same returns regardless of the currency they invest. And borrowers incur the same cost regardless of the currency they borrow. And then you will find the corporates, they are looking for Japanese yen borrowing, US dollar borrowings, euro dollar borrowings. Yeah. But this understanding has to be there. One needs to know that the difference is not coming free. It is not coming free. It is coming through the risk that you are taking. And whenever at any given point of time, when you are going to borrow, the rupee cost borrowing and the foreign currency cost borrowing is actually the same. It cannot be different. That is what is very important to learn. So investors get the same return regardless of the currency they invest. Borrowers incur the same cost regardless of the currency they borrow. Let's look at it with an example and establish an equation. So we have USD and UK. We have two zones. Interest rate in US is IUS and interest rate in UK is IUK. So let us say the 1 year bond is, this is only an example, so don't get the percentages now. So 1 year is at 5% and UK is at 7%. It is at a high interest rate. So what we do is we take $1 and we invest in US. So if we take $1 and we invest in US, at the maturity we will get $1 into 1 plus IUS. That is what we will get. And what we do, equivalent to $1, we convert that dollar into pound. So we have 1 pound. The exchange rate is 1 pound is equal to S dollars, and S is the spot rate. So $1 is equal to 1 upon S pound. So now we take 1 upon S pound and we invest in UK, and the return that we will get is 1 divided by US, 1 divided by S into 1 plus IUK. Now when you invest in pounds, at maturity you are going to get pounds, right? Now on maturity you need to convert those pounds into dollar, and you need to ensure that there is no exchange rate fluctuation affects your investment. In order to do that, you need to take a forward cover. Now, if you take a forward cover, F dollar is equal to 1 pound. That is for the forward cover. So the F divided by F into I plus IUK will be the return that you will get on maturity. Now, given the if this side, that is F upon S into 1 plus IUK, is greater than 1 plus IUS, that is because you are looking at the 7% interest rate. With this equation, if the return from the pound is greater than return in dollars, then you will invest in UK. And if it is not, then you will remain with the dollar investment. Then you will not look for the investment in. So I hope that this equation is being understood over here. What we do is, if suppose there is invest this side, that is F upon S into 1 plus IUK is greater than 1 plus IUS, then we invest in UK, else we will invest in US. So suppose at equilibrium, what will happen? Both sides will be equal. There will be no difference whether you invest in US or you invest in UK. You will get the same return. So we just equate both these equations. And then we have some arrangement of algebra over here. So F upon S into 1 plus IUK minus this bracket is coming on this side, so it will be minus 1 plus IUS. I have not skipped any of the steps for clear understanding. Open the brackets, F upon S plus F upon S IUK minus 1 minus IUS is equal to 0. So what I want to do is, I just want to add plus IUK and minus IUK in the so that is okay. That is normally, we all know that plus and minus will become 0. For some kind of arrangement in order to derive the equation, I do this. When I do this, I will get F upon S minus 1. This minus 1 goes over here. Plus F upon S minus IUK. So it will become F upon S minus 1 into bracket IUK will come out is equal to minus IUS goes on that side becomes plus IUS and plus IUK goes on this side it becomes minus IUK. Now if you're looking at this equation, this part F upon S minus 1 IUK is a product of percentages. It is a product of percentages and so it can be neglected. So we just neglect this and we see what are we left with. We are left with F upon S minus 1 which is equal to IUS minus IUK. What does this? What is this? It is F minus S upon F. Forward minus spot upon spot. What is this? This is nothing but the forward premium. So in this market, the forward premium is nothing but interest rate difference. And that's how law of one price prevails. So forward premium that will exist into the market, it will be exact interest rate differential at any given point of time. The arbitrage forces will ensure that the equilibrium is not shifting. At some period of time, due to some reasons, USD INR has seen that kind of opportunity of arbitrage and that kind of equilibrium exists. A lot of money is being made by people who have means in order to do that. But yes, that is coming because of some other imbalances in the economy and the forces that are taking place. But that arbitrage, strength of the arbitrage, taking that arbitrage on higher volumes comes with this understanding that the forward premium should be always equal to the interest rate difference. And this equation is a connection between the foreign exchange market and the money market. Okay, this equation is the base of the interaction between the foreign exchange market and the money market. This is the way it is communicated. So the forward premium, the moment you will observe that the US interest rates are going to rise up, the forward premium in the dollar rupee will immediately adjust. So we have to again look back to our interest rate and see whether we want to increase and keep the premium stable, or we want to widen the premium, or we want to shrink the premium. So this is the law of one price and the equation we have already derived. Let us look into the law of one price. Forward premium is interest rate differential. This is coming from the foreign exchange market. This is coming from the money markets. So high interest rate currency will quote at a discount in the forward market as compared to the spot market. So if you are looking at the euro dollar rate in the forward market, as of now it is almost same. There is no difference. So if you want to hedge euro dollar, the long term premiums itself are not there. Earlier they were negative, so they were discounted. In the dollar rupee, in our case, the interest rate currency is rupee, it is higher, so we are quoting at a premium in the forward market. When rupee was at 39, 30, 39, 50 and 40 levels, I have observed that for a prolonged period of time, the interest rates were in discount. Even though the actual interest rates were having a differential, where the forward market must quote at a premium, yet the actual market conditions were such that the forward premiums were quoting at a discount. And that is because of the shortage of liquidity into the forward market. So a lot of arrangement was happening. The RBI Governor, Mr. Y.V. Reddy, has managed it really very well. It was when you see crisis, you also see the action of these great masters, how they manage, and the quantum and the human mind, the capability of the human mind that can be. So when you look at Ben Bernanke in US, when he was there during the crisis time and he used to appear into the market and take certain firm decisions, the ripples were definitely being felt, but the vision that these people have are really amazing. And that's what is required. The leadership and the visionary people are required by each and every country, and we have been blessed with very, very strong RBI governors in our history. So there are people, there are countries and economies where the forward premium is not available. In that case, we are always targeting for the expected spot rate. So instead of F, if you are looking over here, you will have FE, which is the expected spot rate. The equation remains the same. So the premium that it will command will be definitely, if you don't know what is the forward premium, you can immediately take the difference in the interest rate of the two countries and conclude what will be the forward premium that we need to charge on the spot rate. So Fisher's theorem says that the real rate of interest is same in all countries. So real rate of interest is nothing but nominal interest rate minus the inflation. So R is equal to R star. So R is nothing but I minus phi, which is equal to I star minus phi star. So I minus I star is equal to phi minus phi star. Now this is the relationship between the interest rate and the inflation. So capital will move to the country with real interest rate, where real interest rate is high, not nominal interest rate. Real interest rate is higher adjusted to inflation. The capital is going to move to that country. So these are the equilibrium. So change in exchange rate is equal to change in inflation, difference of inflation. It will be equal to the difference in interest rate of two countries, real interest rate of the two countries. And that is equal to the forward premium as well as the expected spot rate minus spot rate. So this equation will, all of them, they will be equilibrium at any given point of time. And this is what is going in the currency market. So anytime if you look, there is inflationary pressure that is a concern, and we are looking at the exchange rate. What will be the dollar rupee exchange rate? How it is going to react? What will be the impact on euro INR? What are the measures that have been taken by the central bank on the interest rate? So we are currently experiencing a historical period where interest rates are close to near zero. Whereas most of the countries, there are countries where the interest rate is negative. So there are a lot of stimulus is there. The funds are flowing and finding means to get invested in our country as such, and that's how a lot of capital is being seen flowing to us. So this is a part of international linkages. I just run you through once again because it is important. So law of one price applied to international commodities market, law of one price applied to international money market and foreign exchange markets, covered interest parity, and Fisher's theorem. Also been well covered. So need of forex is primarily to the trade because of the importers and exporters, or we have remittance. We have investment, financial transactions, and for speculation. So major market participants, central banks, commercial banks, individual and corporates, hedge funds, investment funds. Forward contract is a contract which is very, very, for us on the Indian side, we are all looking for the forward contracts. For the importers, we keep on booking their requirement as hedging using the forward contract. The forward date is spot date plus the calendar month, whatever date you require. Forward contracts are customizable. Whenever the bills are due for payment, for that date, exactly you can enter into the contract. So we have outright forward contracts, we have long dated forward contracts, we have broken dates, that is in between, suddenly in between, we have month-end contracts. There are various formats in which the forward contracts are available. It is a credit instrument. Understand this. A forward contract is a credit instrument since it entails counterparty risk. In case of banks, the forward carves out the value of the forward contract on companies' available credit limits in the bank. So if you want if forward contract value is 4.675 crores and the company has an available credit of 50 crores with the bank, the company can avail 50 minus that amount till the maturity of the contract. So your credit limits are dropped when you enter into a forward contract. And to book a forward contract on basis of declaration of exposure, subject to conditions, certain conditions. So the companies can declare what kind of bills or what kind of payments they are expecting. Based on their volume and turnover, they have the banks will give them limits with which they can enter and cancel the forward contract. as and when the way they are required to do. When you get into the details of it, you will understand few things I have already mentioned over there. Your website is tema.rbi.org, will get you all kind of details that you want to know about this market and the intricacies and details with the bank in which with which these things are allowed and how you can deal with them. And these forward contracts can be cancelled as if they are not being required. So they can be freely cancelled and rebooked. So if your dates are changing, you need not worry. You can cancel the forward contract and rebook it. So limits are also available on past performance basis. So the forward contract can be booked on past performance basis. You have a master circular I have mentioned over here. It is a master circular on RBI website. You can refer this to complete detail and read it at your convenience. And if you like to understand everything about the forward contract as to when the way the banks are behaving with your customers. So the forward rate, the forward price is a continuous compounding formula we use. Is S is equal to E raised to RT, where R is the difference in the rates, and T is the time, the period for which it is there. S is the spot rate. So if you have this formula handy, you can punch it into the Excel as per your requirement. And based on the spot rate, whatever is the interest rate difference and the period that you are calculating, you can calculate the forward premium. So when we are looking at the forward rates which are prevailing in the market, they are subjected to a demand supply forces. So you can have actual forward premium, actual forward rate, and calculated forward rate. Based on the interest rate, you can calculate what is the forward rate. So with that understanding, you can know whether the pricing. So in order to evaluate the pricing of the forward contract, whether you are getting it cheaper or you are getting at par, is there any kind of opportunity? That kind of calculations you can do if that interest and is important for you. So we have the LIBOR rate over here, which is the benchmark is under transition. There are different benchmark arrangements that are going on both sides, international as well as our currency side also. Some changes are happening. And these are the spot rates, 73.07, and the cash, and these are September, October, November, February. These are the forward rates for all the currencies. So the forward rates, just for your reference, for export and import, we are having the buy and the side. So if you look at this here, it is mentioned export and import. So if you want to sell, exporter wants to sell, 21 is the price for September. And if import wants to buy, 24 is the rate for September that he can buy. We have the instrument that is currency derivatives, which is available on NHC India. So individuals can participate into this. We are all allowed. There is no delivery. It is only the forward rate. So whenever you feel like that the dollar is going down and it is good, you can accumulate $2, 10 lots. One lot is of $1,000. So maybe 10 lot, $10,000, $20,000. A rupee of difference, and the traders are working on it. It has good volumes for the near month, and the pairs that are available for us to trade. So these are the currency derivatives that have been traded on the exchange came into existence primarily to discover the price when the market opens. So what happens that every day morning the dealer have to start with the price, right? And that takes a lot of all the dealers they are communicating before the market is opening. They have some kind of communication going on among themselves in order to get the price discovered. The first price that comes up on the terminal and the trade happens became very important to discover that price based on all the forces. So it was most of the time done by the dealers, but it was a very challenging task to do to make the market more deep and have the price discovery. Some help is also being seen in the currency futures market, which came into existence, and it is doing really well. We are observing that slowly and steadily the corporates are able to understand the use of these, because here you don't need the bills, here you don't need the limits, and the unit size is almost $1,000. To whatever extent you want, you can hedge your exposure. So the importer will now has a choice whether he wants to hedge using the futures terminal or he wants to enter into the forward market. The primary reason that most of the importers don't want to enter is because it requires margin and it is settled on M2M basis. Whereas in the forward, there is no margin requirement. There is only credit block is happening, some kind of margin collateral the bank will take for its safety as per the risk management norm. But there is no M2M. The cash flow is not there. Whereas in this case, the cash flow is there. Every day, whatever is the differences between CPE, it keeps on settling. So still, the corporates are using it really very well nowadays, and good depth is being seen with the corporate participation that brings opportunity for the small retail tailors to retail traders to make their small differences into the market as gains, small gains. So this market is a bit different from the equity market where someone gains is exactly equal to someone's loss. Here there is business. So the corporate is hedging his instrument. So suppose an importer wants to come and hedge and he goes and buys. Someone who is selling it has a different economics and transition of risk that is happening and he's providing liquidity for which he can be remunerated. Yeah, so it depends. The market is definitely of the traders and the speculators in this currency market. Hedging is also happening for the corporates, and there are people who are developing that kind of skills in order to advise the corporate clients. They have the currency options also, which are now slowly picking up, and a lot of, if you look at the open interest, it's not at par with the volume that OTC is trading, but still it is very attractive. The kind of interest, the put and the calls, the premiums that are being paid and received, and the strategies that are building into the currency market. So it's a very important, very good asset class. The leverage is good. The trades that happen is really very good. So that is on the OTC and the exchange. There are some benefits. One of them that I have already shared with you. Yeah. So yeah, Abhishek ji, is that we have a the slide can go on. So we can stop over here. I think most of the major part is being well covered.
Great, sir. Great, sir.
Yeah.
Satyaprakash sir,
Maybe
it
we
was
can.
a great. Yes. Can we take up some questions, sir?
Yes, please. That's why I like to do that.
Sir, it was really an enlightening session, very insightful session, sir. We really enjoyed while you were deliberating all the concepts of law of one pricing, the different forex transactions and terminology. So that was very nice, sir. Sir, there is a question from one of the member, VK Vijayaji, who is asking about to throw some light on international finance for MSMEs. What is the relevance for like international finance for MSMEs? So this is what the member want to ask about.
So the international finance, that means he's looking for some kind of borrowing. So we had a buyer's credit that was running really very well, wherein even you did not need any kind of limits. A LOU was being issued, and the funds were being arranged on basis on the bills. So ECB loans, buyer's credit, and supplier's credit are there available. One needs to check with their banking arrangement whether that kind of limits will be available, and that kind of requirement for MSME is there or not. Yeah, so definitely the current account is there. So even MSMEs can go and borrow euro, which is very attractive as of now. The fully covered euro INR loan is coming somewhere around 5.5 to 6% fully hedged. So one can most of the time any person who wants to approach needs to understand that the bank on its own may not come and explain you all these things. You need to be aware that these kind of things can be availed, and if you have a current account, you can definitely do it. You can borrow euro, INR.
Thank you, sir. Sir, another question that is coming out to be. Sir, is there a question that when we do the import payments, like we did some import from another country and we have to make the import payments, so we generally take the rate from the treasury of any bank in which we have arrangement with. So while booking up rate, what are the precautions to be taken? Like we do not see the live rate on the Google. Some banks do not provide the live screen. So the bank the bank's treasury is says that somewhere that the margin is 3 paisa 1 paisa, but somewhere around they are playing even more than that. So how can we control over that? How can we be conscious over that? Which tool we can use to see that what is the live rate and the different rates available over the XC website or any other website? So would you throw some light on that part, sir?
Yeah, the rate is always available on your terminal from the NSE exchange. If you have a broker's arrangement where you have the equity segment in which you are dealing, if you go to the currency segment, your rates are there. Even if you put in the spot rates, some of the brokers they provide you the live rate that are being fed from the Bloomberg or the Reuters terminal. So now it is not difficult. Another thing is the futures rate, which is quoting for the 1 month. If you can estimate the premium, how much it is quoting for the 1 month, you can definitely know what is the spot rate that is running. Now the futures rate that is running on the exchange is very very close to the spot rates. Now, treasury is there to make money. The banking treasury is there to make money, right? And those people have really very high pressure when it comes to we don't understand the difficulties that they are going to face. So they have segregated. If we have a $1 million ticket that we are talking about, because the foreign in the banking side, they need a $1 million ticket to get the negotiation done. So what the dealer is doing, if we have a requirement of $1,000, $2,000, $5,000, $10,000, he is making it a quarter million, right? And then he's making half million, then he's making 1 million. By the time he makes a ticket of quarter million, half million, or 1 million ticket size, the prices are fluctuating. He needs to cover that. That is why you whatever you if you're trying to pressurize him to quote him only 3 paisa, 4 paisa, and you calculate it. He is there in the field. So that is the reason why the most important thing for small ticket size participant is to understand and the movement of the exchange rate itself and book whenever the opportunity is right. And as far as possible, they can go on the currency futures terminal and hedge their requirement. Wherein if they are looking for the real good pricing, and then the currency futures pricing, whatever time they want to cancel, at the ease of their convenience, they can go ahead and book with the bank and cancel the position on the terminal. So that kind of arrangement is possible. But if you are looking, even if you are telling 4 paisa or 5 paisa, if your ticket size is less than $250,000, you are somewhere 10 paisa and above is your charges. You need to consider that in your account and not fight with the dealer.
So it varies with the volume we are dealing with.
It varies,
isn't
yes.
it?
The dealer has that kind of requirement.
Requirement. Okay. Thank you so much, sir. Sir, can you also throw some light on the card rates?
The card rates are running bank to bank as per their convenience in order to facilitate the rate at which they don't want to talk to you. They just give you what rate you want to. This is the rate at which you can do the deal or you leave the deal. They are only talking, because they are market makers. They don't have dollars. Bank treasury does not sit with dollars. The moment you do a transaction, they are back to back hedging. End of the day, they are all hedged. Where? So banking treasury is not carrying overnight positions also, right? So when it comes to the card rate and that 1 rupee is your pricing, you have to take it. If you want to really communicate, you need to have that $1 million ticket. Only then they will talk to you, and then they can give you the terminal itself, where even the terminal are all mapped. So if they give you a terminal and you are looking at the live rate and you compare with the Reuters terminal, you can see the difference there also. So even the technology they have played. So do anything. The dealer is not going to give you a free lunch over. He is going to make money. And he is there to make money. A banking treasury is the real profit center of the bank. You look at the balance sheets of most of the banks. And just for a case, the banking treasury, the chief dealer, is really the high paid person. The seniors of the bank are also not that much paid. the incentive of the HSBC treasury head runs in crores. So they are making money there. The
So that
bonuses are
means
in crores,
that
salaries are also in crores.
oh my God. So that means that even if they give us the terminals that are also managed and that are not reflecting the true live rate, so we need to go to brokers and get a terminal from there itself. Can we get a terminals
You
from the
get a
broker
Reuters
itself?
terminal. You can get a Reuters terminal or a Bloomberg terminal, but we will not do that for the volume that we will have. It is costing around $2,000 per month. So we cannot. The normal person cannot afford it, right?
Okay.
So
So
we have to live with that kind of arrangement, and we need to. Most of the time, I tell you, there are the clients are there, the customers are there. They also don't like. They say you take in forex, okay? You give me certain limits to do my work. They're looking for banking limits. So there are banks who give very good banking limits to people who give them profits in the treasury. So a lot of understanding happens in otherwise. Yeah.
yeah. Satya Prakash sir, great said, sir. Great said. So, sir, it is all the questions that we have covered. There are no more questions now. So it means it's very crystal clear to all the members, sir. Sir, now I would like to invite for official vote of thanks CA Lokesh Kothari ji, Secretary Vasai branch of SIRC of ICAI, to please convey sir vote of thanks. Over to you, Lokesh sir.
Thanks a lot, Shiva sir. It is my privilege to give a vote of thanks on the behalf of Vasai branch of WIC of ICAI, organized by Committee on Management Accounting CMA of ICAI and hosted by Vasai branch of WIC of ICAI. Firstly, I would like to express our sincere thanks to our speaker, Satyanarayan Prakash sir, for your excellent coverage, giving valuable inputs to member on management accounting insights, international finance with respect to derivatives, forward contracts, and various other forensic reserves. I would also like to thank Committee on Management Account CMA for giving us the opportunity to host this type of wonderful webinar for our members. With these words, I end my words and also thank all the participants for your wonderful response in today's webinar.
Thank you so much, Lokesh sir.
Many thanks to all of the participants also. That they are very important to us also. Yeah, Shiva.
Sir, your PPT was very elaborative indeed, and you were like running through the equation by equation, so participants were understanding each and every equation. So you did not miss any equation. So that was the thing that we really appreciate, sir, Satya Prakash sir.
Wow,
And
that is great.
participants are also asking about the PPT that they will they get the PPT also, sir?
Yes, it is definitely very much available. I have shared it with Gyanji, and he will make arrangement that it reaches. So my, one of my desires when I was working on this system was, it always came to my mind that somehow or the other I should reach all chartered accountants in the country and give all this information to them. So Gyanji and Dr. Surendra Palji has made my dream come true with this kind of webinars where my voice can reach all of them, and important insights that a chartered accountant must know and help their clients in order to also understand the requirements whenever they are going into any kind of borrowing abroad, and in order to help them understand that the difference is coming from some kind of risk that they are taking. So long as the interest rates are going to be low, they are going to enjoy the show. The moment the interest rates will rise, the FX side is going to be very hard on them. Yeah? So some influence will happen. Thank you so much.
Yes, sir. It's a complete cycle at all. We understood from your presentation, and many participants have given wonderful remarks. Thanks for the excellent presentation. Thank you so much, sir. Sir, we look forward to have further insights from your side. And with this, I think, sir, if there is no query further, so Lokesh sir and Chairman sir, Satya Prakash sir, can we now move towards the closer,
Yes.
sir?
Yes, thank you so much. I will take your permission and conclude over here. Many thanks to Abhishek ji and Lokesh ji once again. Thank you very much, Shiva. Had been wonderful best with that. Thank you.
Thank you so much. Stay safe, stay happy. Thank you so much for your patient hearing. Thank you all.
Thank you, sir. Thank you so much.